Today I want to talk about borrowing, and I want to also talk about the stock market. So it's a well-known fact that if you pulled all the money in the world and subdivided equally such that all of us have the same amount of money, it will not take long before poor people becoming poor again, while the rich people, the people who are millionaires, becoming millionaires again. Why is this so? So it turns out that most of the people are spenders, while we still have a couple people who are investors. So when you borrow money to spend, you are not only eating into your future, but you are also making that future harder, since you have to make enough money to cover for the future as well as the past in which you borrowed. And when it becomes harder to pay for the expenses and still repay the loan, you default. It's that simple. So there is a smarter way of borrowing into your future. You never borrow to spend, but at least borrow to invest. So borrowing, what's borrowing and what's a loan? So 99% of the richest people in the world, they started by taking a loan and used it as a springboard for borrowing from their future without the risk of defaulting. So when borrowing a loan, there are two numbers that you should pay attention to: the interest rates and the annual percentage rate. The interest rate is exactly what it sounds. So if you borrow 100 shillings at 4% fixed interest rate, you pay 104 if you repay in 1 year. So APR, on the other hand, will give the total cost of the loan, since the 4% interest rate does not account for things like late fee, loan origination fee, among other fees. So the APR gives you the actual cost of the loan, and it's always higher than the interest rate. So let's talk about the stock market. So the stock market and the money market. So the stock market is a way in which you can borrow from your future without risking to default by opening a business and taking it public. So if a business has a track record of profit and growth, the investors will definitely be interested in investing money into your business. How it works is you determine the current value of your business, both the assets and liabilities, and the net profit per business financial cycle. So the net profit, if invested back in the business, can help determine the rate at which your business is growing. The investors will look at the future value of your business to to give it a fair valuation depending on the shares you would like to put up for sale in the initial public offer, that is the IPO. So when you determine the number of shares that you want to put up for the IPO, you will get the money worth a percentage of the business that you have sold shares. You then set up a management team comprised of a board of governors, business operations office, finance office, public relations office. Of course, you will need legal, and it's very important to have research and development, among other offices. So in order to at least run that business without deception. So that way, you will get cash from the sale of shares, which you can use to expand the business, expanding your business, hence opening more branches and unlocking other markets, and generating more profits, and hence increasing the value of your business. So in every business cycle, you will share the profit you generated with the shareholders. This means you take the total net profit, you divide it by the total number of shares in the market, and this is now the so-called earning per share. So the amount the shareholder gets will be the earning per share multiplied by the number of shares that shareholder owns. This way, you have just borrowed from your future without having the risk of defaulting when selling shares. When selling shares, those shares should be classified as non-voting shares, that someone does not pop up from nowhere and buy over 50% of your shares and become the CEO, taking away your business. So here in the United States, people try opening all sorts of businesses hoping it will be a hit and they can take it public or sell shares to other investors like the Shark Tank. So you do not have to wait 30 years for your business to grow and make you a millionaire. You just get that money overnight, living into your future. So in the case you don't want to go public and you do not want to work with the Shark Tanks, then selling franchise is another option, where you sell a permit to an individual who uses your trademark and following your business model and then paying you a commission. Monoline company is a good example of franchise business model, even though they are not in the Nairobi Stock Exchange. So Kenyan businessmen, they don't like going public, and that is why those businesses never get off their feet. So any idea that can be commercialized should be taken public, and the Kenyan software engineers and IT people should start developing apps that can enable a regular Kenyan to buy shares of publicly traded companies without having to physically go through a financial broker. And there is still a lot of opportunities there, so do not be afraid to give it a shot. Try it, it's gonna work.